Hyperinflation, massive inflation is coming your way, and that's what most of the YouTube videos are warning you about. Now, you guys know I'm a contrarian. I tend to think and do the opposite of everyone else. So in this video, I'm going to argue why I don't think we're going to have massive inflation. Now, we are going to have slightly higher inflation than where we are right now, but not massive inflation. So in this video, I'm going to break down the best assets to own that's going to build your wealth as we go from very low inflation to normal inflation in the next few years. So what is inflation? It's the rise of the price of goods and services. And it's something natural, something we experience all around us. Like when I was a kid, it cost like $1.50 to watch a movie. Today, a movie ticket costs $12 to $15. My younger days, it cost just $30 for a nice meal at a restaurant with my family. Today, it costs at least $150. So that's inflation for you. Now, we measure inflation by the percentage change in what is known as the Consumer Price Index, or CPI. So this index is a basket of the usual household goods that we purchase. If you take a look at the last 30 years, from 1990 to where we are today, you can see by and large, inflation has been moderate, which is below 3.3%. So inflation between 2% to 3.3% is moderate inflation, and that's where we've been. In fact, currently, inflation is considered very low at only 1.8%. So what's the concern? Well, the concern is with all this recent money printing, where the government in the US, they're pouring trillions of dollars into the economy, that could create too much money supply, and that could create hyperinflation back in the 70s and 80s. What happened then, right? You can see in the 70s and 80s, inflation went through the roof. It went up to 7%, 10%, 12% inflation. So could this happen right now? I don't think so, even with all this money printing. Why not? By the way, money printing is not something new. The Federal Reserve has been doing it for the last 10 years. They started with QE1, quantitative easing 1, where they printed lots of money during the financial crisis. So that was 2009. They did QE2 in 2010, QE3 in 2014, and recently QE4 in 2019. So despite all that money printing and bringing interest rates to zero, inflation didn't really go up. In fact, inflation remained 2.5%. And in fact, like I said, right now inflation's at 1.8%, which is really low. So why isn't all this money printing creating inflation? Because there's another powerful force that's pulling inflation down. So what's this powerful force? Well, that's what I'm going to explain in this video. But before I explain it, you have to understand first and foremost what causes inflation. The first thing that can create inflation would be an increase in the money supply. So when the central bank, like the Federal Reserve, they print money and they inject it into the economy, what happens? That's right, more money in people's hands, more demand for goods and services, increases the price of goods and services. So if you take a look at how the money supply has increased, it's been really crazy. In fact, since September 2020, the Federal Reserve, the US Central Bank, has printed and injected $9 trillion into the US economy. $9 trillion. If you take $9 trillion and you divide it by the total US population of like 328 million people, that is about $27,000 per person. So what happens when people have more money? Again, they will bid up the prices of goods and services, and theoretically, inflation should rise. In fact, in the last 12 months, 20% of all the US dollars in existence have been printed in the last 12 months. So you get theoretically too many dollars chasing the same goods, and that creates inflation. So many people are saying that this sudden increase, or this massive increase in the recent money supply in the last 12 months, is going to create hyperinflation. Seems to be logical, right? But they're forgetting one thing. It's not really the money supply that causes inflation. It is the circulation of that money. And what's really interesting is that although money supply has increased, but the circulation of the money has actually fallen. So if you take a look at this chart over here, you can see that money supply has been increasing. And like I said, this happened in the first QE back in 2009. Over here, you can see there was a spike in the money supply. The Fed printed money into the economy in the financial crisis, happened in 2009, 2010, 2014, 2019. So as the money supply increased, inflation didn't go up. Why? Because take a look at this thing, which is called the velocity of the money supply or the money stock. So velocity measures the actual circulation of the money. That means, are people actually using it to buy and sell goods and services? And you can see that in actual fact, since the year 2000, the velocity of money has actually collapsed. So why is this so? Where's the money going? So the money being printed is not going into the hands of people that are actually buying goods and services. All the money that's being created, printed by the Federal Reserve is only going to the banks and the financial institutions that are hoarding the money, right? They're not spending, they're hoarding it. And also a lot of the money that's created, this wealth created, is only going to the wealthiest 1% of people in the US and in the world. So the thing is that money is there, but the wealthiest 1%, they're not spending the money because they already have so much money, they're just keeping that money. Now think about it, right? So you've heard that because of the recession and pandemic, the rich are getting richer and the poor are getting poorer. But the rich are only the top 1%. So as a rich person, I could be 1,000 times richer, 10,000 times richer. But does it mean I'm going to eat 10,000 more bowls of food? No, I still eat 3 meals a day. So a lot of that money is saved and invested into assets. And that's why you see stock prices keep going up, real estate prices keep going up, and even speculative assets like cryptocurrency, non-fungible tokens, specs, they keep going up. Whereas the majority of the people out there, the 99%, they're not getting the bulk of the money supply to spend on essential goods and services. And that's why the CPI, the Consumer Price Index, which is based on these household goods and services, isn't going up that much. And hence, general price inflation has been low to moderate. So you can see that increasing the money supply itself may not cause much higher inflation. But what else causes inflation? There are two other things: demand pull factors and cost push factors. So the second thing is what we call demand pull factors, which is basically the increase in demand for goods and services which exceeds production capacity. So remember, it's all about demand and supply. So if there's more demand for goods than supply, prices will go up. So could there be an increase in demand that outstrips supply? Well, possibly yes in the short term because of the global economic reopening. So as more people get vaccinated, people want to go out and they spend money. So there's a lot of pent-up demand for traveling, pent-up demand for entertainment, and there's what we call revenge shopping. You want to go out there and spend, right? So if there are a lot of people who want to go out there and spend a lot of money, and again, the demand exceeds the supply, that will cause inflation. But again, this is going to be very short-term and transitory. It's not going to be long-term. So why is there not going to be long-term increase in demand that's going to outstrip supply? Well, because of technology. What a lot of people don't realize is that technology and innovation is actually deflationary to the economy in the long run. Why? Because technology and innovation reduces the buying power for goods and services among the masses. As you get more and more technology, technology creates automation. And with more and more automation, this eliminates millions of jobs in the economy, reducing the demand for labor and hence the amount of wages that are paid out to the masses. I mean, think about it. Because of the invention of Amazon, one company, it has eliminated millions of jobs in the retail sector, right? Millions of people have lost their jobs as cashiers in malls, in grocery stores, eliminated jobs of retail salespeople, of security guards that used to be in malls again, right? Store managers, data center engineers, their jobs have been lost because of Amazon Web Services that have taken over their jobs in companies. What else? You think about it, right? The invention of Zoom has eliminated millions of jobs in the conference and meeting industry. Like in my company, I used to spend lots of money running seminars in exhibition halls and all those things. But because of Zoom, It has eliminated the need to hold events physically and eliminated millions of jobs that I used to pay for running my physical events. So with all these people losing their jobs, oh, by the way, robots are also expected to replace up to 20 million factory jobs by 2030, right? So if all these wages being lost by these people, this will reduce the buying power of millions of consumers. As a result, this deflationary effect will reduce the effect of the short-term inflation caused by the global reopening or the economic growth because of the pent-up demand. So like I said, short-term there'll be inflation, but in the long run, because of this, it would reduce inflation in the long run, and hence it's unlikely we're going to have that hyperinflation that people are talking about. Third and last thing that could create inflation would be the increase in production costs that goes into the making of goods and services, and hence reducing the supply of goods and services. So, for example, if there's a global supply chain disruption because of global warming, all right, this could increase commodity prices or raw material prices that increases the cost of businesses, and they then have to raise the price of goods and services and creates inflation. Or historically, whenever the economy reaches full employment, there's a labor shortage and this increases wages. But will this happen now? No. Again, like I said, because of technology and automation, this is no longer happening. It is eliminating millions of jobs, and because of that, wages are not going to increase as much as they have in the past. At the same time, technology actually reduces the cost of production of goods and services. In other words, technology allows companies to produce goods and services at lower and lower costs, and allows companies to increase the supply of goods and services to meet any kind of demand. So when that happens, there's no way you can have high inflation, because whatever demand people have, companies can scale up the supply to meet the demand, bringing down prices. So let me give you a few examples. So number one, technology has reduced the cost of media consumption and increased the supply of media to the masses. So with Netflix now, with just $10 a month, you can watch unlimited number of movies. So can you see, if you compare today from many years ago, now it costs less to watch more movies. So that's not inflation, that's deflation. Second example would be if you were a recording artist. Years ago, if you wanted to record a studio quality album, you would spend thousands of dollars renting a studio, getting people to manage the studio, and you have to get a producer to distribute your songs. But today, you can do it all for free. A free app called GarageBand from Mac, plus with YouTube, you can produce studio quality albums and distribute the songs to millions of people within a few hours. Is that inflation? That's deflation. So now it costs you less to achieve more. Again, third example would be Zoom, another very good example. Now, I've been running my education company for 18 years. In the past, I had to spend easily $50,000 to $60,000 to run a physical event, to hire the venue, to hire operations staff, to manage the people and all those things. Today, I run the same event online with Zoom at almost zero cost. So again, can you see how technology reduces the cost of business, reduces the cost of production, and is actually deflationary to the economy? So in summary, even with all this money printing, money supply, even with the global economy reopening, we are not going to have hyperinflation. Why? Because of technology, because of the fact that the majority of the money supply is concentrated in the hands of the richest 1% of the banks and financial institutions, and the money is not circulating. We are not going to have hyperinflation, but we are going to have slightly higher inflation than what we've had in the past. Again, currently our inflation is about 1.8%. I expect it to go up to maybe at the very most 2 to 3%, which is pretty moderate inflation. So while we won't have hyperinflation, we will have slightly higher inflation. So question, is inflation good or bad? The answer is it depends. Inflation is good news if you are an asset owner, if you own assets, you own shares of great companies in the stock market, you own real estate. Why? Because inflation means higher prices, which means the companies you own can raise their prices. You can bet in the future Nike would price their shoes higher than today. Apple would price their products, iPhone 15, iPhone 20, a lot higher than today. So as companies raise their prices, their revenues increase, their profits increase, earnings per share increases, and hence share price will increase. So inflation guarantees higher prices in the stock market. It also means that if you own real estate, you can charge higher rents over time. With inflation, with higher rents, your property values, your land values will increase as well. So again, inflation is great for people who own assets. But inflation is bad if you don't own assets and you're only a wage earner, if you only earn active income through your employment, because your wages are going to buy less and less goods and services over time. I mean, years ago, $20 could buy an entire month of groceries. Today, $20 can just buy you a couple of bags of chips and some Tic Tacs. So I advise people all the time to learn to create multiple sources of passive income, whether to create an online business or to learn to trade the financial markets or to invest into assets like stocks of great companies or real estate investment trusts that's going to create passive income for you. Now, inflation is also bad if you only save and hold cash. Because of inflation, your cash is losing value every single day, month, and year. Think about it. A 2% inflation rate means every year your currency, your cash, is losing 2% of its value every single year. If you compound that, that's kind of like losing 34% of your wealth every 20 years. I don't know about you, but this scares me to death. And that's why I always ensure that every time I've got surplus cash, extra cash, I'm always investing that cash to grow. Because if it's not growing, it's depreciating. So the point is there's always going to be inflation. We can't stop inflation, but we can either allow inflation to work for us or against us. If you own assets, inflation works for you. If you don't own assets, inflation works against you. So you got to learn how to invest. Now, a lot of people are afraid of investing. They say, but isn't investing risky? Well, everything is risky if you don't know what you're doing. But I tell people this. The riskiest thing you can ever do for yourself and for your family is to not invest. Not investing is the riskiest thing you can ever do. Why? Because again, if you don't invest and you just hold cash, you're guaranteed to lose 34% of your wealth every 20 years. Some people think that holding cash is the safest thing that you can do in today's uncertain environment. Wrong. Holding cash is the worst investment you can ever make because holding cash is a guaranteed loss. You're guaranteed to lose money when you hold cash. If you take a look at the US dollar, for example, in the last 100 years since 1913, the US dollar has lost over 95% of its value. Now, it's not just the US dollar, it's any currency that you hold, whether you're holding euros or Singapore dollars or Japanese yen, it's the same thing. You're losing money every day you're holding cash. And that's why Ray Dalio, one of the top fund managers, has a famous saying that says, cash is trash. Now, let me clarify that. I'm not saying that you don't hold any cash. You gotta have enough cash to pay your expenses. For your daily needs, you need cash for emergencies. What I'm saying is surplus cash. So I tell my students, I say, always ensure that you've got enough cash to pay for at least 3 to 6 months of your expenses. Now, of course, you got to have a job to keep the cash coming in. But what I'm saying is beyond your daily expenses, cash that you don't need for the next 2 years, surplus cash, you got to invest that. You got to invest it to grow that to be financially free and financially secure. So that's what I mean. Now, so the question would be, what do I invest that surplus cash in that's gonna not only beat inflation, but it's gonna grow my wealth so I can be eventually financially free, financially secure out of the rat race? Now, there are many assets that can beat inflation and build your wealth. But out of all the assets, my favorite asset, and to me the best asset to invest in would be stocks, investing in the stock market. Now, again, when you buy stocks, remember that you're not buying a lottery ticket that you hope is going to go up. you're buying a piece of a business. So I like to use the word stocks and businesses interchangeably. And to me, investing and owning businesses are the best assets to own. Now, if you don't know how to pick the right business, the right stock, if you simply buy the index, the S&P 500 index ETF, which means you're buying a portfolio of the 500 biggest companies in America, you will definitely beat inflation and grow your wealth in the long run. So from this chart, you can see this green line down below, that's the consumer price index, or the CPI, that measures inflation. So you can see that in the long run, prices of goods and services rise by about roughly, again, 2 to 3% a year on average. And this orange line that you see there, that's the S&P 500. So again, without timing the market, without picking individual stocks, just buying the index over the long run, even though in the short term it goes through ups and downs, but in the long run, you beat inflation by a wide margin. On average, the S&P 500 index returns on average in the long run about 10% per annum. So that beats inflation. If you want to catch my latest videos, click on the subscribe button right now. Click on the bell so you get instant notifications once I upload my latest video. If you want to check out my online courses, go to piranhaprofits.com. We're going to learn how to invest and how to trade the financial markets and create an income from all around the world. If you want to join my live Wealth Academy program, go on to wealthacademyglobal.com and find out more about how you can learn investing and trading live online. This is Adam Khoo, and may the markets be with you.